So you might have heard the Federal Reserve has cut the rates. But what does this actually mean for mortgages and loans? Let's leave the professional explain that.
When the Federal Reserve cuts interest rates, many people assume mortgage rates will immediately fall. But the relationship isn't simple. Let's break down how Fed rate cuts actually affect mortgage rates. What the Federal Reserve actually controls. The Federal Reserve does not directly set mortgage rates. Instead, the Fed controls the federal funds rate, which is the interest rate banks charge each other for overnight loans. When the Fed cuts this rate, it lowers borrowing costs across the financial system, especially for short-term loans like credit cards, auto loans, and business lines of credit. What actually drives mortgage rates? Mortgage rates are primarily driven by the bond market, not the Fed directly. Specifically, 30-year mortgage rates tend to track the 10-year U.S. Treasury yield. Why? Because investors compare the return on safe government bonds to mortgage-backed securities. If Treasury yields rise or fall, mortgage rates usually follow. How Fed rate cuts influence mortgage rates indirectly. So even though the Fed doesn't control mortgage rates, its decisions still matter. When the Fed cuts rates, it can signal slower economic growth, reduced inflation expectations, increased demand for bonds. When investors rush into bonds, bond prices go up and yields go down. Lower yields often lead to lower mortgage rates. Why mortgage rates don't always fall after a cut. So mortgage rates can stay the same or even rise after a Fed rate cut. That's because markets are forward-looking. If investors expected the cut weeks or even months in advance, mortgage rates may have already adjusted. In some cases, a rate cut can signal economic strength or persistent inflation, pushing bond yields higher instead of lower. Timing matters. Mortgage rates usually move before the Fed acts, not after. By the time a rate cut is announced, lenders have often already priced it in. That's why waiting for a Fed cut before buying or refinancing can be risky. What this means for home buyers and homeowners. A Fed rate cut doesn't guarantee lower mortgage rates, but it can help create the conditions for them. If inflation cools and bond yields fall, mortgage rates may decline over time. For buyers and homeowners, the key is watching bond yields and inflation data, not just Fed announcements. So while Fed rate cuts influence mortgage rates, they do so indirectly through investor expectations, inflation, and the bond market. Understanding this connection helps you make smarter decisions about buying, refinancing, or locking in a mortgage rate.